That's the closing bell on Wall Street, and now it's Market Domination Overtime, sponsored by Tasty Trade. Let's take a look at where the major averages ended this session. Very slightly up off the lows of the day for all three major averages here, but the Dow still falling by 972 points. That's a drop of nearly 2.5%. As I mentioned earlier, we are seeing a little bit lower than average trading volume today. Just was chatting with Kenny Polcari of Slatestone, and he mentioned that it is a market holiday for some of the markets in Europe, and so that could be one of the reasons that we are seeing that. The S&P 500 down 2.4%. Again, a little bit of a lift off the lows, but not much. And the NASDAQ down by 2.5%. Not seeing much better here, whether you're looking at the small caps down 2.25%, or some of the large cap tech names. Now, elsewhere, we are watching carefully what's going on in other asset classes today. We've been talking a lot about this. The 10-year yield at 4.4%, ticking up a little bit. So seeing selling not just in stocks, but in bonds as well here today. Not seeing money come into the U.S. dollar. It's down as well. The dollar index, as Kenny mentioned, also breaking below 100 today as we see it, the dollar fall against a basket of currencies. Where are we seeing the money going? Not into crude oil either, by the way, down about 1.8%. It is going into, to some extent, into Bitcoin today, although Bitcoin has not been able to sustain a rally as of late. But today, up 3.3%. And it is still going into gold, up more than 3% on the day and trading at another record. So that has been seeing sustainable demand as people have been looking for what they perceive as safer areas. Now, digging down into stocks a little bit here and looking at the sectors that are moving the most here today. Consumer discretionary down 2.7%. Obviously, as we've been talking about the so-called hard data, that is not survey data, but what the data is actually showing about what people are actually spending, has held up relatively well. But there is concern that we're going to see deterioration there. Tech also down, energy down, and utilities. Those are the groups that are underperforming the S&P 500 on the day. And we continue to watch what's going on in large cap technology pretty carefully here. Tesla, which is set to report after the close tomorrow. There's a lot of trepidation about what the company's going to say, not just about its numbers, but about the future path of its lower cost vehicle that everybody's waiting for and the plans for the robo-taxi. The stock down 6%. Nvidia down another 4.5% as there's been some reporting from Reuters that Huawei is developing some competing chips for the ones that Nvidia is not allowed to sell in China anyway. You see here Amazon down by 3%. Raymond James still bullish, but getting less bullish on the stock. And Wells Fargo is saying that Amazon might be pulling back on some of its data center plans. So we are still seeing this sort of drip, drip, drip of negative news that is affecting many of these specific companies as well as the macro vibe pretty negatively, Josh.
All right, thank you, Julie. Let's bring in now Carl Farmer. He is a VP and portfolio manager at Rockland Trust. Rockland has over $7 billion in assets under management. Carl, welcome to the show. I know you got three stocks you're looking at right now for clients, Carl. Let's run through those. One is Nike. Why does that make your radar, Carl?
No, sure. Hey, thanks for having me on today. Appreciate it. So one of the things about Nike is that people have to realize that this is not a 2025 fix. You could get a pop, and you've seen that when the off and on again tariff announcements. But if they end quickly, you may see a resumption in terms of trying to fix the story. The company had issues even before the tariffs. Trying to reinvigorate the brand. The CEO's been there decades now in terms of coming in and trying to reinvigorate things and repair some of the relationships that were damaged a little bit with the direct-to-consumer initiative. But with the stock not at prices not seen since 2017, this level provides a good entry point should they get back to the $3 to $4 share of earnings power. But they have some work to do.
Another stock that you're looking at is Air Products, big industrial gas company here. Is this one also that is sort of a little more tariff-proof, or is it just, there's going to be demand for its products no matter what? How are you thinking through that?
Oh, sure, a little bit. So as you mentioned, it's a market leader in industrial gas. It's kind of trading at a big discount to its peer, Linde. Usually there's about 10% on that. It's now about 30% off of that multiple. The future growth can come from new products, projects, and clean energy transition. But the main thing that you focused on was the strong and predictable recurring revenue model. It's not completely recession proof in terms of if there's a slowdown in the economy. Certainly their customers will be purchasing less, but in terms of the tariffs, this is certainly one that we like going forward.
A final one, Carl. How about Pepsi? Also on your radar. Name's down about 20% over the past 12 months. You look at that name, Carl, what's going to get this one moving in the right direction?
Well, so the recent results have led to the low sentiment and the discounted multiple that it faces today. The productivity savings from here, though, and the fact that they should grow volumes, this can offer a little bit of a positivity as we look forward. They have flexibility across their platform with value pricing across their product lines. And it's not off much year to date. As you kind of mentioned, some of the defenses, whether it's staples or utilities, have held in pretty well. But it is off 20% in the past 12 months. That also gives investors a 3.8% yield while they wait and maybe see if they can weather through some of the GLP-1 damage that's been done.
Carl, you speaking about weathering that reminds me that people want these picks right now because they're concerned about weathering everything that's going on at the moment. And so I'm curious if that's what you're hearing from clients. If they're coming to you and saying, where can I hide right now? Where can I look for stability right now?
Oh, absolutely. Well, as your previous guest, Kenny, had mentioned, investors don't like uncertainty, and that's kind of where we are. The announcement, delay, modification, timing and duration or potential duration of what these tariffs could be has created a lot of uncertainty. And the main thing to remember about that, of course, is that they're never deflationary. So as you said, you have clients that are asking, well, do I need to do anything differently or kind of what are you guys looking at? And the challenge is that when you had inflation trending lower from 3% towards the Fed's stated goal of 2%, now facing tariffs, you may see an increase in prices that is not sort of what was on the radar a couple of months ago. So the pressure now that's been announced for the Fed to cut rates soon, not really as a result of further inflation reduction, but to combat a potential rise in unemployment if there's an economic slowdown, and most importantly, economic growth. So we're trying to find names that, as you mentioned, that at least at this point, trying to find things that may have been punished a little bit more than in the past, and maybe you can see a little bit of a rebound here as we move forward. But whether it's in staples or utilities, certainly there are things that can hold up a lot better in this sort of tariff and unknown certainty environment we have.
Carl, we got some big names on deck reporting earnings this week, Tesla, Alphabet. I'm just curious what you make of what you've heard so far during this earnings season, Carl, and what are your expectations for corporate profit growth ahead?
No, certainly. I think, as you mentioned, the couple of names there, Tesla, I think a lot of investors are truly wondering what is the volume level and sort of what will all the tariff announcements mean going forward. Certainly, there's a lot of questions in terms of the ability to focus on areas, whether it's in DOGE or whether it's in the helm of a business. So I think they're looking for any sort of clarity they can have as we move forward throughout 2025. Alphabet is actually a name we own, we like. Certainly they're facing some challenges now, not just from the Department of Justice, but from other areas in terms of the parts of the business that they can kind of grow and move forward from here. But we still like the name. Communication is certainly an area, and these multiples certainly like it as a discount to the market going forward, considering they've been able to grow it in excess of the market. But I think with all the uncertainty, investors really need to see companies deliver on expectations and reassure their investor bases here.
Yeah, definitely. Carl, thank you so much. Appreciate it.
Absolutely. Thank you.
President Trump's fundraising during his second inauguration, setting a record with a more complete accounting of the donations. Yahoo Finance's Ben Worskull joins us now with the details. Hi, Ben.
Hey, Julie. Yes. So Trump raised $239 million as part of his return to office. This is the fundraising apparatus that's specifically around his actual inauguration. It's separate from the campaign. And this was primarily driven by donors that giving checks of $1 million. We knew a lot of these. A lot of people publicly announced, and a lot of companies publicly announced, but there was 140 donors in total that gave $1 million or more. All told, this sort of shatters all previous records. The previous record for an inauguration was $107 million, which Trump raised 8 years ago for his first inauguration. This more than doubles that and sort of surpasses the last 3 inaugurations, even if you put them together. And overall, we saw about 650 donors here that really reflect the kind of breadth, a kind of snapshot in time of Trump's business world support from his time in office. It was people on the list included from Sam Altman to Chevron, from Blackstone to BlackRock, from J.P. Morgan to crypto firms. The biggest giver, interestingly, was a poultry company called Pilgrim's Pride Corporation, which gave $5 million, but it went all the way up and down. And this filing also comes as business world world's support for Trump is being tempered a bit by the tariffs that you guys were talking about previously. This is two names on the list that are interesting to me were Walmart and Target. Those were on the list of big givers. Those two companies are at the White House today to make a plea for Trump on tariffs.
I'm just curious, Ben, did any on the donor list, did they then join the administration?
For sure, there was quite a few. So this list was individuals and companies, and on the individuals there was a lot of Trump appointees on there. Scott Bessent gave $250,000. Cantor Fitzgerald, which was run by Howard Lutnick at the time, gave a little over $1 million at the time. And then the top three donors are all Trump appointees. They gave over $2 million each, and they're things like the ambassador to the UK, the NASA administrator, things like that. So a lot of the giving, which happens in previous, but it's on a whole new scale here for certain.
Ambassador to the UK. That sounds nice.
Sure.
Not a bad gig. Thank you, Ben.
Yeah.
Right, thank you. Appreciate it. Stick around. Much more market domination overtime still to come. Google back in court facing off the Department of Justice to prevent a breakup of its search empire. Yahoo Finance's Alexis Keenan joins us now with the very latest. Alexis.
Hey, Josh. Yeah, so this was the first day of the remedies phase of this trial, and it's meant to restore competition in the search engine market. That's where Google was held to have had an illegal monopoly. And then you just go back a week ago, not even a week ago, and Google was held to have had an illegal monopoly in the advertising technology market. But this search case here, the DOJ is asking for a judge to force Alphabet to divest its Chrome browser to end contracts that put its search product and default placement across different devices, and also to block Google's use of AI tools in order to preference itself. Now, the DOJ also wants the judge to consider the possibility of a divestment of Google's Android operating system. And reports from inside the courtroom today say the DOJ was accusing Google of repeating the same tactics in AI that it made to get its search into a monopoly position and to hold on to that monopoly. The DOJ said that Google was paying to get its Gemini AI chatbot on Android devices this time around. The DOJ said it would also plan to call to testify, represented from OpenAI, to say that the company struggles to some extent with distribution of its chatbot and also to compete on some level with Google's level of search query data. Now, Google, for its part, said that divestment of Chrome would break the browser. They say that the risk to divest Chrome, because it is part of an ecosystem that functions with other Google products, that would really have a risk of personal data being disclosed to the wrong sources, and also national security risks, Google says. They, on the other hand, they want the judge to let browsers continue to choose their own search engine and to have those contracts rebid on an annual basis. They're also asking for the judge to let those OEMs that use Android be allowed to preload any search engine that they want. Now, as for AI, the company says that it would really impede U.S.'s competition with China in that market if it were to go ahead with these proposals. One thing we've heard for one of the first times from Assistant AG Gail Slater, Trump's choice to lead the antitrust division of the DOJ, before opening statements, she did talk about this AI dispute. She said the Trump administration has prioritized policies that support and advance AI, but that nothing would advance AI faster than open and competitive marketplaces that are free from gatekeepers, calling Google a gatekeeper here, and monopolies. The online search market, she said, has been frozen in place for decades. And so, guys, no matter what happens here at the end of this search phase, it's expected to last 3 weeks. We're expecting a decision in this remedies phase from Judge Mehta by August. No matter what, if there's any consequence to Google that hurts their bottom line, we would expect Google to appeal. The DOJ can for its part as well.
So buckle up. It's going to be a long process. Alexis, thanks so much. Appreciate it. President Trump again called on Fed Chair Jerome Powell to cut interest rates after threatening to oust the Federal Reserve Chairman last week. For more on the latest tensions between the White House and Chair Powell and how this could play out, let's welcome in Jeffrey Lacker, former Federal Reserve Bank of Richmond president and GMU Mercatus Center senior affiliated scholar. Jeffrey, thank you once again for joining us. We wanted to get some insight from someone who was at the Fed about what is going on right now. Obviously, Jay Powell has been very firm that he is not stepping down, he is not leaving. But what do you imagine the sort of vibe to be like in the Fed while all this is going on?
So on the one hand, this can be water off their back. They could ignore this quite easily, put their head down, get on with the analysis of what monetary policy needs to do in the coming months and years. I think they're on hold. I think they would have been on hold whether Trump criticized them in public or not. On the other hand, it's not helpful. It calls into question with some who might not be so closely familiar with the operations of the Fed. There are other market participants who might come to believe that the Fed would bend, would yield to Trump's pressure. So they're certainly viewing it as unhelpful.
Jeffrey, when you read those posts by Trump, I mean, obviously he got very personal and goes after Powell, and Powell is late and he's a loser. He also did talk about preemptive cuts, right? I'm just curious what you made of that.
So I think it would be bad policy right now, but it's again not helpful. It's likely to erode the value of the dollar. It's likely to push bond yields higher. And I think that's why some of his closest advisors will understand the connection between the Fed's credibility and the outcomes that the president and the administration undoubtedly want, which is more robust economic growth in the United States. Understand that something that erodes the Fed's credibility, that leads people to think higher inflation is on the way or more likely, is not going to be helpful to their cause.
Jeff, just one line of thinking I'm curious to get your take on it is you might hear folks say, well, the recent inflation readings we got were benign, and to the extent that we see any, tariff-induced higher prices, they'll be transitory, temporary, not persistent. And really the big worry now is growth. So yes, the Fed should be getting ahead of this. They should be cutting. You say what to that, Jeff?
So first of all, it's early on. It's early inning. This is like the first or second inning. The data we have, we don't have any data after the April 2nd and then April 9th tariff announcements. And that data in terms of prices isn't going to really roll in until later in the summer because you've got a lot of stockpiling that's gone on. The prices really aren't going to hit for a couple of months. And then there's going to be a willingness by some firms to absorb it in the short run, but not in the longer run. So this is going to play out over the course of a year or more before we see the real inflationary effects.
What are the risks of a non-independent Fed, of a Fed that would be influenced more by the White House?
So one doesn't have to speculate. We've had two instances of that in history that were glaring and turned out very badly. The late 1960s, Lyndon Baines Johnson put tremendous pressure on the Fed chair at the time, William McChesney Martin. He had him out to the Texas ranch, drove him at high speed around the rutted ranch roads in a Cadillac convertible. There's a great picture of this online. And was just excoriated him. I mean, he was verbally abusive. It was terrible, and it caused the Fed. It caused the Fed to temper its fight against inflation as the Great Society programs and the buildup in the war in Vietnam added demand pressure that raised the inflation rate over the course of the late 60s. We ended up having inflation go from 1.5 to 5 in the course of a couple of years. After that, Arthur Burns took over as Fed chair under President Richard Nixon, and Nixon very explicitly pressured him to ease monetary policy going into the 1972 election in order to aid the re-election of the president. Wage and price controls helped keep inflation down over that interlude, but when The inflation controls were lifted in late 1973. Inflation shot up from 2 or 3% to over 13%. And we were off to the races with go stop monetary policy and it took a decade or more for the Fed to wrest control of inflation, wrestle inflation to the ground and get it down to a moderate level. So we've had two very bad episodes with pressure that ended bad for the American people.
Jeff, I'm curious, just got a broader question. What you make of Trump's tariff strategy? You know, the goal, Jeff, the tactics. How do you think through it as an economist?
So one can picture an argument. I don't support this, but an argument for reshoring and building up manufacturing here in the United States. If one wanted to pursue that, though, this isn't quite the way one would implement a tariff program to that end. First of all, you'd want to accept the material inputs that go into manufacturing, the manufacturing activity you'd like to attract, and that would include a lot of manufactured goods abroad. One would also want to make the tariffs look permanent. So you want legislation for that. You'd want to phase them in because you want investment decisions to take into account the tariffs, but you'd want the short-term pain to be minimized, and you would do that by phasing them in. So it doesn't look like it's well calibrated to achieve that sort of end.
Jeff, great to have you on the show today. Thanks so much for your time today. Appreciate it.
Sure, my pleasure.
Time now for What to Watch, Tuesday, April 22nd, sponsored by Tasty Trade. Going to start off here on the earnings front. Tesla announcing first quarter results after the markets close. Elon Musk company, the first of the Magnificent Seven companies reporting this season. Analysts expecting Q1 to mark the bottom for Tesla, with recall and protest headlines signaling a tough quarter. Yahoo Finance will have special coverage of all things Tesla tomorrow, with coverage starting at 4 p.m. Eastern.
Sticking with earnings, we'll be getting some reporting from the defense sector, including RTX, Lockheed Martin, and Northrop Grumman. Lockheed announcing first quarter earnings in the morning. Analysts expect the company's profits to go up this quarter, driven by better margins and strong demand for its missiles.
And finally, more Fed commentary coming in tomorrow from Fed Presidents Patrick Harker, Neil Kashkari, and Tom Barkin. This is coming after last week's sharp sell-off following comments from Fed Chair Jerome Powell. Powell saying that the effects of tariffs are moving the Fed away from its dual mandate goal of price stability and maximum employment.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. Got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.